Let's kick things off with a pretty wild hypothetical. I want you to ask yourself right now, would you go to work tomorrow for a literal $1 annual salary? No guaranteed cash bonuses, no hidden safety net, just a single $1 bill. Probably not, right? But what if the ultimate payout at the end of that road was nearly $750 million? Welcome to The Explainer. Today, we are unpacking one of the absolute most extreme all-or-nothing corporate compensation packages we've seen in recent memory. And more importantly, we're going to look at what this massive bet tells us about a company that is fighting tooth and nail to rewrite its entire story.
When you actually dig into Opendoor's 2026 proxy statement, the numbers are just staggering. CEO Kaz Nejatian took the helm and agreed to that $1 fixed annual salary. His entire compensation package is weighted 97% toward performance-based equity. The potential payout? Up to $741 million. But here's the catch. This isn't free money. It is locked behind what the Proxy officially calls rigorous and challenging stock price hurdles. To understand why any CEO would take this kind of high-stakes gamble, we really have to look at the rubble he inherited.
You probably remember this. A few years ago, the market treated Opendoor like a total crash victim. Their stock plummeted 99%. It was a trajectory eerily similar to Carvana's early days. Wall Street basically wrote them off as a terminally broken business model. They saw a bloated house flipper that was just a zero-interest rate phenomenon, carrying a ton of fragile balance sheet debt, operating in only about 50 markets, and fundamentally relying on home prices going up forever just to bail out their pricing errors. But hidden under all that rubble, the actual bones of a massive tech disruptor were just waiting to be unearthed.
Chapter 1. Dismantling the old Opendoor and rebuilding in founder mode.
When Kaz Nejatian was appointed CEO in September 2025, he wasn't alone. Co-founders Keith Rabois and Eric Wu came back, and they didn't just tweak things around the edges. They took a sledgehammer to that fragile, debt-heavy legacy model. The executive team went into full, aggressive founder mode. The steps were incredibly systematic. First, they slashed their aged inventory, cutting it from half their book down to just 1/10, and aggressively cleaned up the debt. Second, they drastically tightened their buy box. They focused strictly on high-confidence flips to kill cash burn, engineering a new model that could actually generate positive margins even if home prices declined. And third, they absolutely hit the gas on expansion.
Let's talk about the sheer speed of that execution for a second. 380. Under Nejatian, Opendoor expanded to cover more than 380 metropolitan statistical areas across the U.S. in roughly 10 weeks. Just to put that into perspective, it took prior management a decade to reach 1/3 of that market. This was a massive 7 to 8x expansion of their addressable seller supply practically overnight. The key takeaway here is that the Wall Street analysts who were pricing Opendoor as a $1.50 stock were analyzing a company that literally didn't exist anymore. They entirely missed the tech-driven speed of this rollout.
Section 2. The AI data flywheel and building an autonomous real estate trader.
So, how on earth do you pull off that kind of expansion speed? Well, Wall Street completely misunderstood the core of the new Opendoor. It is not just about flipping houses. They're essentially building an autonomous real estate trader. The whole tech stack revolves around an automated valuation model, or AVM. This AI engine processes millions of data points to make real-time, completely data-driven pricing decisions on what to buy, renovate, and sell. It's a massive data flywheel. Every single transaction makes the machine smarter. And then they started layering on high-margin products. For example, they rolled out a proprietary 4.99% mortgage product, which is about 100 basis points below the market rate. And get this, it was built by literally 4 engineers in under 10 weeks. They took high interest rates, their biggest headwind, and turned it into a massive competitive moat.
And the proof is in the pudding. In the Q1 2026 earnings, Kaz Nejatian plainly stated, "The machine is working." And the data totally backs him up on that. Their late 2025 and early 2026 acquisition cohorts are showing the absolute best combination of margin stability and resale velocity in the company's entire post-COVID history. They drove contribution margins to their highest levels in nearly 2 years, tracking right in that 5 to 7% range. And the craziest part? They did this while national home prices actually softened. The model completely held up under stress.
Part 3. The stock price gates and the $741 million gamified quest.
Okay, so the turnaround is clearly working, but let's circle back to that $1 salary. If you read the actual proxy statement, this compensation package is laid out exactly like a video game. It's a gamified quest with brutal levels you have to unlock to reach the final prize. Level 1 starts right here, $6.24.
This is the baseline for his first award of 40.8 million performance-restricted stock units. When he took over, the stock was sitting under $6. So to even begin time vesting this first massive chunk of equity, the stock price has to hold an average of $6.24 over a 60 trading day period. If the stock drops and stays down, he gets absolutely nothing.
But look, that was just the tutorial level. Now we get to the boss fights. Nejatian was granted a second award of another 40.8 million shares. This one is broken down into 7 rigorous price gates that act like progress bars filling up. He has to sustain a 60-day average trading price at $9. Then he has to push it to $13, then $17, $21, $25, and $29. Think about what that takes. He has to radically compound the company's entire market capitalization over and over again across a 5-year performance period just to unlock these tranches.
And that brings us right to the final boss, the $33 price gate. To fully realize that massive $741 million potential payout, Kaz Nejatian must drive Opendoor's stock to a sustained $33 a share. From where the stock started when he first took over, that requires an astronomical multiplication of shareholder value. It perfectly, literally aligns the CEO's ultimate windfall with massive sustained gains for the investors. I mean, this is the absolute definition of having skin in the game.
Section 4. The Road to 82 and Probability-Weighted Reality.
Now, you might be sitting there wondering, is a $33 stock price even mathematically possible, or is this just some meme stock fantasy? Let's actually anchor these wild hurdles in hard data. We're looking at some comprehensive, probability-weighted financial modeling derived from deep-dive retail due diligence. You'll often see this referred to as the Road to 82 thesis. This model maps out the actual stock price projections based on the company's weekly acquisition run rates and margin trajectories. In the bear case, say execution totally falters and margins compress, you're looking at single digits, roughly $6.10 for 2026. But look at the base case. If management literally just hits their current guidance, ramping up to 1,500 to 2,000 homes acquired per week with a very modest 10 to 15% attach rate on that new mortgage product, revenue hits $15 billion by 2027. That implies a stock price around $15.40 by the end of 2026 and $36 by 2027. Suddenly that $33 final boss price gate isn't fantasy at all. It aligns perfectly with just standard base case execution. And then there's the bull case. If we see higher volumes and the market finally re-rates them as a true AI platform instead of a cyclical house flipper, the target shoots up to over $73.
So let's weigh the odds. When analysts break down the market sentiment probabilities of these scenarios, they weight the bear case at 25%, the base case at a highly probable 55%, and the bull case at 20%. When you blend all of those together based on current momentum, it yields probability-weighted targets of $16.80 for 2026 and $36.60 for 2027. The math flat out shows that the mechanics of the CEO's bet aren't pulled out of thin air. They're deeply grounded in the company's projected revenue and margin scale.
And what actually justifies these aggressive valuation multiples? It all comes down to the bottom line. As of their Q1 2026 update, Opendoor announced they expect to be adjusted EBITDA profitable on a 12-month go-forward basis. They are hitting adjusted net income break-even. They've officially transitioned from making promises about future profitability to establishing a rock-solid track record of actual execution.
So, what do we take away from all this? Is Opendoor just a $1 meme stock illusion, a leftover relic from the zero interest rate era? Or are we witnessing the ultimate skin-in-the-game turnaround, entirely driven by an AI flywheel and a CEO who literally bet his entire salary on a massive gamified quest for profitability? The machine is working, the debt is clean, the targets are locked in. The only question left is, will Kaz Nejatian beat the game and claim his $741 million loot? I'm going to leave that one for you to decide. Thanks so much for joining me on this explainer, and definitely keep your eyes on those weekly acquisition numbers.